Welcome to Connecting Capital to Wealth. Ty Lassiter here. I'm the CEO of KeyCity Capital, along with Stephen Patterson, the Chief Client Officer here at KeyCity Capital as well. So Stephen, tell me, the market here recently has just gone all over the place. We're seeing interest rates just skyrocket drastically. What do we see that doing going through 2023?
You know, I think there was a hope at one point in January that we'd see a soft landing. We haven't had a soft landing since 1994, where we actually raise interest rates without actually putting the economy into recession. However, inflation went up year over year for the month of January, but you coincide that with Jerome Powell taking a softer approach with a quarter-point interest rate hike. I don't think that's good news for the next Fed meeting, and I think that the interest rate hikes are probably going to get a little more aggressive. The idea of recession on the horizon is probably a little more likely.
Yeah, I mean, we've kind of been, within our company, we've been expecting that, and expecting it to last probably into 2024 significantly. I think what we're doing, what we're seeing with the slower interest rate hikes now as opposed to 2022, I think we're just delaying. We're delaying that recession. I was on the radio last week talking about this. I would rather see, let's go ahead and do with the interest rates what we need to do to go ahead and get a recession going that is just looming, instead of having consumers look at what inflation hit 6.5.
6.5% for the month of January.
So we're at 6.5. Like we are looking into the eyes of a recession. Yeah. Let's move into it.
No, and there's no question. I mean, if you just look at the yield curves right now, the 2-year Treasury being significantly above the other longer held Treasuries, particularly the 30-year. I have deep concerns around that. I mean, that's been an accurate predictor. And those yield curves, when they flip, typically can stay as long as 18 to 24 months. So to your point, are we in a recession? Are we not? Are we delaying the inevitable? Is a soft landing possible? I think until we get inflation under control, that's a huge factor. But, the other piece that's out there that I think, gives me great pause for the summer is energy policy.
Yeah, well, I think we dipped into 26 million barrels in the federal oil reserves.
Yeah, without a doubt. I mean, the Biden administration has not produced an effective energy policy yet. And listen, I think all of us want sustainable energy. I don't think there's any question around that. But the facts remain that right now we're an economy that's built on the petrochemical industry across the spectrum, right? And fossil fuels are here for the foreseeable future. Not allowing new drilling, not allowing the Alaskan pipeline to function at full capacity. I mean, we can move 2 million barrels a day through the Alaskan pipeline, and we're moving about 300,000 barrels a day.
Goodness. So oil reserves now in the United States are what? They're at their lowest since 1983. That's 1983. The year I was born.
Yeah, I mean, what effectively we're doing is we're using the strategic oil reserve much like you might use your savings account. If you're using your savings account to balance your checkbook, your savings account's not going to last long. The strategic oil reserve's being used the same way. We're going to move out of these winter months. Refineries are going to go back to a summer blend of gasoline. The Chinese economy is coming out of COVID, starting to turn on. I think that it's very real that we're going to look at significant gas price increases. When gas prices go up, groceries go up, goods and services go up, because there's nothing that you buy in the United States today that doesn't come in either a truck, a rail, or air. And so that's going to be affected by diesel prices, and that's going to be affected by jet fuel prices. When those prices go up, your consumer prices are going to go up.
You and I were talking about this yesterday, and it's not necessarily a demand issue, that demand is outpacing supply. It's the ability to buy is outpacing supply right now. And it's significantly impacting the cost of goods, which is causing inflation to skyrocket. I mean, you mentioned the Treasury yield at,
4.5 on the 2-year.
4.5 on the 2-year. And so it was in the ones
Yeah.
a year ago, you know,
That's
and so now the Treasury yield is increasing, but inflation is increasing
Significantly.
and so a dollar is sitting there still losing value, no matter what, no matter where you put it in a bond.
This is, 1983 Ronald Reagan supply side economics all over again. We can raise interest rates indefinitely, but until we have the supply side of this solved, whether that's gas prices or whether that's the supply chain, you're going to continue to see inflation rise. In fact, if you just look at rents, okay, for us to get to 2% inflation, all other indicators would have to go negative because of the pace of rent increases. And as these interest rates go up, rents are only going to accelerate that much more.
Well, I think you brought up a good point. That's why we're also focusing our acquisitions in markets where there's job growth.
That's right.
We haven't acquired much in Dallas. Our main headquarters is here in Dallas. We've acquired a lot in Florida, along the East Coast, along the Southeast. We do have an office in Naples, but we haven't bought a whole lot of assets here in Dallas until recently. And we're seeing, there's been north of 20 Fortune 1000 companies relocate here to the Dallas market. And so that is deriving a demand for affordable rental property. Workforce housing is what is in huge demand here. I think demand is outpacing supply. By the last I looked, it was in the high 30% margin. And so that's giving us great opportunities. And then you mix into the fact that interest rates are increasing and a lot of the hedge funds have stopped heavy acquisitions in real estate. In fact, if you Blackstone last week, they have halted redemptions. They're no longer acquiring. They were heavily acquiring assets, single family and multifamily rental, and they've stopped that because they've seen a lot of redemptions. Well, their cost of capital was so cheap. Now the Treasury yield is outpacing it.
Yep.
And so they're having a difficult time matching that. And that gave an opportunity here. I
think there's an interesting statistic around that, that I think is worth talking about. You have 360,000 people in the United States every year moving into the state of Texas. Of that 360,000, we're seeing 120,000 of those move into DFW. That's a great market to be in if you're owning real estate.
Yeah, we've seen most of our investors are involved in our investments partially because of cash flow, right? And so when we invest, I look for 4 key factors for an investment, and really advise anybody looking at an investment. You should be moving into an investment for cash flow. You should be putting your money to work, and it should be creating cash flow for you. It should also be growing in value. And real estate does those two things. Owning real estate gives a tax advantage, so you should be tax advantaged on where you're putting that capital to work. But you look at our investments, and really the focal point to that is the growth. And so somebody invests in real estate, they invest in one of our funds. They're going to get cash flow, but now the Treasury yield is getting close to that, and it's crazy in the 2-year Treasury yield. But inflation is outpacing that still.
Absolutely.
What is some of the impacts of an inflationary market that is just moving upwards like it is at such a rate that it is right now?
Yeah, at the end of the day, inflation means that your dollar doesn't go as far. So if you had $100 in a savings account and you sat on it for a year, that $100 is now worth about 93 cents. Year over year, inflation's gone up 6.5%. So you've lost 6.5% buying power. That's the most simplest terms. Where the argument comes in this economy is this supply based or is this monetarily based? Now, we're raising interest rates to make money more expensive, but I'm not sure that that's solving the problem. It's not that we have too much money chasing too few goods, it's that we have too much money chasing way too few goods. It's a supply side issue. But with that said, let's bridge this into KeyCity Capital, and let me ask you this. Tell me how KeyCity Capital is dealing with inflation right now.
Well, that's a good question. I broached on it a minute ago as we moved into the Dallas market. But with moving into the Dallas market, what we're seeing is, 2 things. One, we're structured as a private equity fund, so we're diversified. Our investors come in, unlike most of the other real estate operators, most real estate operators raise capital and they deploy it on one asset at a time, and then they move on to the next asset. So each investor goes into that one asset. If something happens to that asset, that investor's money is tied up all in that one basket. Our funds are typically acquiring 6, 10, 12 properties or assets within that one fund. So now we are in the Dallas market a lot heavier, and what we're doing here is we're doing debt assumptions. So interest rates are hitting 6%, 7% in some of the bridge facilities. And so in a bridge facility or a bridge interest rate is when we acquire an asset that we're going to do a value add to, right? We're going to renovate the product a little bit, increase rents, and then we're going to refinance typically into agency debt. So we are one of the few Fannie Mae, Freddie Mac preferred borrowers. That took getting to about $500 million in assets under management to finally get on that platform. So we're at a much smaller, we're in an elite group, if you will. So a lot of the other real estate buyers in DFW are focusing on single assets at a time. So they're raising smaller dollars of capital at a time, and they don't have the access to capital that we do. So what that does is that makes it where they have to go in and they have to get new debt. So when they're buying an asset, they're looking at an asset and they're saying, okay, we need to get 75% leverage on this property. So $10 million property, they need $7.5 million in a loan. Well, to do that with interest rates at 6 and 7%, an investor's not going to meet the DSCR requirements or the debt service requirements that the bank is going to put in place. So now they can't afford that loan.
Yep.
So what we're doing is loan assumptions. We're coming in, we're buying a property that is ready for a new buyer, but we are assuming the debt that's in place. What that means is that our leverage is lower. So for us as an investor, the risk is a little bit lower. We're coming in, we're buying a property with about 55% debt in place, and that debt is still in the 3% profile. Yep. So we're paying 3% interest, whereas our competition is going to be paying 6% interest. We're getting less leverage, and we're able to raise more capital faster because we're offering a product to our investors that's diversified. That investor is not only getting into this one asset, they're getting into 6 assets. If something happens, a hurricane hits one of the assets that we have in Florida, the other 5 aren't in Florida and they're not going to be impacted by that. Or let's say that the first asset that we buy has a little bit less capital expenditures needed to be done. So we're buying an asset, it's already cash flowing. And if you'll follow us in our next episode, one of the episodes coming up, we're going to talk about one of the assets that we're buying right now and how it cash flows. We're buying that asset right here in Dallas, and it's already cash flowing day one. We're doing very little capital expenditures on that, but some of the other assets in the fund have capital expenditures against them. So during the capital expenditure period, not as much cash flow coming in. Well, this cash flow offsets what's not happening over there. But those other opportunities have higher upside than this one that's cash flowing today. So cash flow today, higher upside tomorrow. You blend those together and you get a much stronger product that we can offer to our investors. And so those debt assumptions are a huge opportunity that we're taking advantage of right now when our competition is looking at 6% debt and we're getting 3% because we have the ability to raise higher capital.
Now that makes a lot of sense, and I think it kind of leads us to the next discussion point, and I think this is a great one for people to understand. So inflation is up, and we use the example of 6.5% year over year for the month of January. So, you know, for every dollar that you had in your savings account, that dollar is now worth 93 cents. The buying power has been reduced. However, when we're talking about rental real estate, when we're talking about real estate in general, inflation has a very different effect on it. Explain to them how inflation worked to their advantage if they were invested in our fund.
Yeah, so you've got dollars setting in your savings account or in your retirement account maybe. We take investment dollars from cash to retirement accounts. So an investor has $1 million or $100,000, whatever it is, setting in their savings account. That $100,000 a year from now is worth $93,000. Okay. Well, you invest into one of our funds. Our investment properties that we're investing in, our real estate properties, like you mentioned earlier, they're rental properties and they're following inflation. Now, we're not moving as quickly as inflation because we're able to buy a lot of these assets at a discount. Our economies of scale, we've got 600 million in assets under management. We've got about 5,000 apartment units. And so we're preferred vendors to a lot of manufacturing companies, and we're able to get our product a little bit cheaper. We're able to get labor a little bit cheaper because we employ so much labor across our products, and we're able to do it quicker. We've got bigger teams. Right now, as an example, in Florida, we've got a couple of large teams in Florida working on our properties, but a lot of individual users who are needing renovations done aren't getting as quick work done because we've got a lot of long-term guaranteed work for a potential employee or laborer in the Florida market. So our volume helps create opportunity. So now an investor invests, we increase rents along with inflation. Now we're offsetting the impact of that dollar if that dollar stayed in a savings account. Or even worse, and we're stressing out about what the market's doing right now. A dollar that's worth 93 cents a year from now is actually worth about 1.8 or 108 cents a year from now in one of our investments because of the cash flow, because of the growth, and the upside opportunity that we'll have as we go to sell those assets in a strong economy. And you ask, well, how are we going to do that in a strong economy? That's why we got into rental real estate a long time ago. Flipping real estate is a huge hedge. That's a huge bet. You're betting that the market is going to be at or above where it was when you bought in 6 months from now, or whatever the case may be. With rental, you invest in a property, and let's say we expected to hold that property for 5 years. We're cash flowing along the way, and at year 3, the market was so strong that we decided to go ahead and sell. We're actually doing that right now in a couple of our funds that had a bunch of properties in Florida. But let's say the flip side happens, and let's say you're in a market that you invest today, and 4 years from now, the market still isn't what you wanted to sell at, and it starts to go down. And then in year 5, you've got a down market. Well, we're just going to hold until year 6 or 7 and then sell then. Yeah. So no matter what, we control the market and we control our exit in this type of an investment.
No, it makes a lot of sense. And I think those are, 3 key points that are worth, going back, and let's underline it, let's highlight it, and let's talk about it again. Inflation's up. Well, when inflation's up, rents are up. Inflation's up. When inflation's up, property values are up. And when inflation's up, the value of the dollar's down, but you're cash flowing all along the way to keep pace with that, and you're producing money from your investment.
I think you made a good point with that. And actually, if you check us out, KeyCityCapital.com /podcast or KeyCityCapital.com, KeyCityCapital.com. You can actually register, or you can have a phone call directly with Stephen. You can schedule a call with him, or you can check us out and kind of look at what our investments are doing. What are the markets that we're in, and why are we in those markets? I think that brings up a good point. Stephen, we've got investors all across the United States. We don't have properties all across the United States. No. Why not?
Yeah, we're focused in on the southeastern United States. So, I always like to say for the college football fans out there, we like that SEC footprint. And, there's a lot of data to support that. I saw just last night, looking through the news, 500,000 residents left the state of California over the last 2 years. 500,000. Where are they going? Well, a lot of them are coming right here to Texas, like we talked about earlier. 360,000 new residents in the state of Texas, 120,000 of them finding their way into Dallas-Fort Worth. When you look at the 2020 census, you had California lose seats in the House of Representatives. You had New York lose seats in the House of Representatives. Well, who were the beneficiaries of that? Who gained those seats? Because, House seats are directly related to the population of a state. Texas gained from that. Florida gained from that. Tennessee gained from that. So we want to be positioned where people are moving, because where people are moving, there's an opportunity for people like us that have rental real estate to turn a profit.
I think that's a really good point. When you start looking at the states that we go into, you really see, and it's one of the things that we focus on. We focus on population growth. Yep. But one of the key things that we focus on is, you mentioned it, higher education. Mm-hmm. So we're focusing on markets that by nature, inflation may impact that market,
Yeah.
but the negative impact and the real estate specifically is not as impacted as heavily because of the population growth. I talked about it earlier. We're in Dallas now, and over 20 Fortune 1000 companies have relocated here in the last 2 years. Well, most of the markets that we go into, we're looking for higher education. With higher education comes a stable marketplace.
Yeah.
But right behind higher education, we're looking for major medical. When you've got major medical, you're going to have jobs. You're going to have nurses. A lot of nurses live in our multifamily properties. A lot of first responders are living in our multifamily properties. With those two things, again, strong economy. You add to that, the third thing that we look for is major financial. And then the fourth and final thing that we really look for is diversity of employer. We don't want any one of those three segments being the sole or major employer there. We want multiple jobs. And so when you have a market that has significant population growth, you find those four things. And yeah, there may be inflation in that market, but the residents in that market are having the benefit of inflation as well. They're seeing opportunity behind inflation and they're taking advantage of it. And that's really what we produce to our investors, like we talked about earlier. As we go into an economy of inflation, you've got to start looking at where can we offset the impact of that. And I think you've done a good job. You work really closely with our clients. We've got, I think, what do we have, 550 investors now?
A little over 550, yep.
What would you say are probably the top five demographic of investors? And I know doctors are way up there, but.
Yeah, sure. Doctors certainly rank up there. I think professionals as a whole that are
looking. A bunch
looking.
of professional athletes.
Yeah, a lot of professional athletes that are beginning to work with us. We have a large segment of our investor pool that's currently retired. Young professionals that are, maybe distrusting of the market, distrusting of Wall Street, that are looking for an alternative investment style, certainly play into that.
The young professionals is a good one. You see, we've got a number of entrepreneurs and young professionals that, and the doctors are the same, professional athletes are the same. These are people that they do a great job of earning high income. Like they know how to generate a high rate of income. But oftentimes either they don't have the time, they don't have the knowledge, they don't have the sophistication, they don't have the scalability to go out and manage their investments. And it's a hard thing. We've got a bunch of investors that were real estate investors themselves that are now investing with us, and they find that our scalability makes the investment opportunity easier. They no longer have to deal with a tenant and a toilet and problems in the middle of the night.
Yep.
We do that at scalability and deliver a better return than they were when they were having to work to manage that.
I think a great example of that being, a client that I was just working with the other day, and they had, at one point in time, they had 5 rental properties. Nice little portfolio that they had built for themselves and did very well with it. But they brought up an interesting point. When they had one person not pay rent, they lost 20% of their income. They only collected 80% on their rental income for that month. What they liked about coming into our funds is that, they're now exposed to 1,500 units. Now, we don't ever want to say, well, it's not a big deal when one person doesn't pay their rent, but one person not paying their rent doesn't affect 20% of the overall return.
You make a really good point there. And you brought up units. One of the most important pieces of real estate, one of the most important metrics in real estate, that we talk about occupancy all the time. We talk about NOI a lot of the time, or your purchase price, your assets under management. None of those are the most important metric. The most important metric is number of units.
Yeah.
How many units do you have? Because with our situation, right around 5,000 units, as scalability grows, your percentage of vacancy is going to decrease. So I mentioned earlier, you can check us out at KeyCityCapital.com, but how else we do dinner events. Tell everybody about our dinner events and how people can follow us and get to learn a little more.
For those of you that are in the Dallas-Fort Worth area or the Southwest Florida area, we do a monthly dinner event at those. And so you can find those on our website. We'd love for you to come and join us. It's a free dinner, and it's an opportunity to hear more about our investments, more about how you can plug in, and then if this is a good fit for you and you qualify, we'd love to just set up a one-on-one to talk about how to get you involved in the products that we're offering and why our investments may make sense for you.
Yeah, I mean, you were talking about Southwest Florida. We've got our Naples office down there. We do monthly dinner events in Naples. And we've got properties from Naples all the way up to Tampa. We're in Gainesville. I mean, we are scattered all across the southeastern United States and continuing to add to that. So at our dinner events, we go into what our product looks like for you as an investor. But you're also going to learn how we find our products, what we're doing with our products, and why we're investing in those products. And we've got investors all the time. I mean, out of our 550 investors, most all of them like the aspect of owning a physical asset.
That's right. They
want that physical asset, and all of them talk about, hey, I want to go see some of your properties. I've taken a number of investors on tours. We give our investors maybe a list of properties to go look by, and then we find that they end up not going and doing it. I think it's just the thing of knowing that I own that physical asset. It's not like the stock market. You got a piece of paper that arbitrarily has a value to it at any given time. You own a physical asset, and that physical asset's not going away.
Yeah.
And I think that's just a unique aspect to our investors. What are some of the things that you find as you talk on a daily basis with our clients? What are some of the things that you find that they really enjoy? Let's end on, what do they really enjoy about our product?
Yeah, no, I think that it comes down to just a couple of key components. Monthly cash flow. It's just something that makes sense to them. I've invested in an asset and I see a return on that asset on a monthly basis. Tax efficiency. We're able to take the depreciation on the asset and offset that gain. So those dollars are essentially, depending upon your tax bracket, that percentage higher. Because we negate the taxes on those dollars. And I think the third piece that you have talked about extensively today is it is a physical asset. If they want to get in their car and go drive by and look at it, they can. It's not a piece of paper. It's not an electronic line on the ticker as it goes by on the bottom of the screen of the business channel of your choosing. But it's sitting there, and they know that there's a security in that.
We look forward to connecting with you guys. Check us out on KeyCityCapital.com, KeyCityCapital.com. Ty Laster, CEO of KeyCity Capital. Stephen Patterson, he is our Chief Client Officer at KeyCity Capital, where we are connecting your capital to wealth. So check us out. Look forward to hearing from you, or follow us on any social media platform, YouTube. Reach out. Look forward to answering any questions that you might have. We'll see you next time.